Imagine waking up to find your money's worth has significantly dropped overnight. That's exactly what's happening in Japan right now. The yen, typically a safe haven in times of crisis, has weakened to a 5-year low against the dollar. This isn't a random event, but the result of several contributing factors. First, we have rising global interest rates. As the cost of borrowing increases worldwide, currencies like the yen that have lower interest rates tend to weaken. Then, we have the soaring prices of energy and commodities. Japan, being heavily reliant on imported energy, especially from the Middle East, has seen a sharp deterioration in its terms of trade. Lastly, there's Japan's shrinking current account surplus. A current account surplus means a country is exporting more than it's importing, leading to more money coming in than going out. But in Japan's case, this surplus is shrinking, indicating a potential economic slowdown. In the past, during financial shocks, the yen has rallied as domestic investors repatriated overseas holdings. But this time, it's different. Interest rate differentials, safe haven appeal, and underlying economic growth are all working against the yen. What does this mean for Japan? Well, it's a daunting economic challenge. The overall outlook for the yen is negative. As the yen weakens, it increases the cost of imports, leading to higher prices for consumers and businesses. This, in turn, can slow down economic growth and lead to a vicious cycle of economic decline. With the yen's collapse, Japan's economy is on a tightrope, and the balance seems to be tipping towards a tough road ahead. As the world watches, one thing is clear: the land of the rising sun is facing a setting economic sun, and the question is, how will it rise again? The collapse of the yen isn't just a local problem, it's a global concern with potential far-reaching implications. When we look at the broader picture, we see a domino effect in play, one that could lead to financial turmoil, not unlike the 1997 Asian financial crisis. Yes, you heard that right. We're potentially looking at a rerun of one of the most devastating economic meltdowns in recent history. The Japanese yen, traditionally seen as a safe haven in turbulent times, has reached a 2-decade low against the US dollar. This downward spiral isn't just causing furrowed brows in Japan, it's sending shockwaves across Asia. Why, you ask? Well, further depreciation of the yen could be the catalyst that tips the balance, plunging the region into financial chaos. Let's take a moment to talk about China. The economic giant is no stranger to currency market interventions, and this time might be no different. With the yen's continued weakening, China may feel compelled to step in and protect its own economy. The 1997 crisis began when Thailand's baht was unpegged from the US dollar, causing speculation against other Asian currencies. China's decision to keep the yuan pegged to the dollar helped stabilize the region then. Could we see a similar move now? The yen's downfall also puts pressure on China, with the currency having dropped 14% in 2022 and 19% over the past year. It's a precarious situation, no doubt, and one that the world is watching closely. We need to remember, currencies don't operate in isolation. They're intrinsically linked, part of a global financial web that connects us all. So, a dip in the yen isn't just Japan's problem, it's a worldwide issue, a ticking time bomb that could have severe implications for global economies. The ripple effects of the yen's downfall are being felt far and wide, putting global economies on edge. Now, more than ever, it's crucial to be informed, to understand the potential impacts and to prepare for what may come next. In an unsettling echo, the British pound has also experienced a significant slide against the US dollar. The scene in the United Kingdom bears a striking resemblance to the economic predicament currently unfolding in Japan. The same undercurrents of financial uncertainty and investor trepidation are evident, underscoring the global nature of this crisis. Britain's economic outlook under its new Prime Minister, Liz Truss, has been met with a mixture of apprehension and speculation. the pound has taken a hit, depreciating significantly, reaching a rate last seen in the mid-80s. This has led to a surge of anxiety around a potential collapse in confidence in British assets and a looming balance of payments crisis. Adding to the complexity of the situation, Prime Minister Truss has plans to unveil a staggering £100 billion package. This financial maneuver, aimed at capping consumer energy bills, is said to be funded by increased government borrowing. This has only served to stoke the fires of uncertainty, leaving investors and economists alike on edge. The pound has already lost nearly 10% of its value since early June. This decline has been driven by a combination of internal changes and external pressures, from soaring gas prices to concerns about global growth. The parallels with Japan's situation are hard to ignore, with both nations grappling with a weakening currency and the potential fallout on their economies. This is not to say that the future for the sterling is all doom and gloom. Some predict a slight increase in the pound's value in the coming months, while others warn of a potential fall to a near all-time low. What becomes clear is that, much like Japan, the UK faces a potential crisis of confidence, and the steps taken in the near future will be crucial in navigating these turbulent economic waters. With the pound having lost nearly 10% of its value since early June, the UK, like Japan, faces a potential crisis of confidence. As we delve deeper into the complexities of these economic scenarios, we're reminded of the interconnectedness of global economies and the ripple effects that can be felt far and wide. In the midst of this crisis, the Bank of Japan finds itself in a nightmare scenario. As the yen continues to freefall, the Bank of Japan is caught between a rock and a hard place. On one side, there's the threat of runaway inflation, a monster that eats away at the value of money and can devastate economies. On the other side, we see wage growth crashing, leaving the average Japanese worker with less purchasing power, even as prices rise. So, what can the Bank of Japan do in this precarious situation? One option is to hike interest rates, a time-honored strategy to stabilize a struggling currency. But this is no magic bullet. In fact, it's a bit like hitting the brakes on a speeding car. It might save you from a crash, but it's going to jolt everyone inside the vehicle. Now imagine that car is the global economy. An interest rate hike in Japan could send shockwaves around the world. Higher interest rates can make Japanese goods more expensive, hurting exports and slowing the country's economic growth. But the ripples don't stop at Japan's shores. In our interconnected global economy, a slowdown in one of the world's largest economies could drag others down with it. And there's another twist to this tale. As interest rates rise, so does the cost of servicing debt. For a country like Japan, with one of the highest levels of public debt in the world, this could be a major problem. Higher interest payments could lead to more borrowing, creating a vicious cycle that's hard to break. But what's the alternative? If the Bank of Japan doesn't raise rates, the yen could continue its downward spiral. This could lead to even higher inflation and potentially trigger a currency crisis. It's a dilemma that would give any central banker sleepless nights. The Bank of Japan's choices in this crisis could have a profound impact, not just on Japan, but on the global economy as well. And as we watch this drama unfold, it's a stark reminder that in our globalized world, a crisis in one corner can quickly become everyone's problem. In this turbulent economic climate, there are key points that everyone must understand. We've seen the shocking collapse of the yen to unprecedented levels, and it's not happening in a vacuum. This downfall is interwoven with global economic forces, and its implications stretch far beyond the shores of Japan. The yen's decline is more than just a national crisis. It's a potential trigger for a global economic crisis. The intricate web of international finance means that when one major currency stumbles, the shockwaves are felt worldwide. As the yen weakens, it puts pressure on other Asian economies, potentially sparking a financial crisis similar to what we witnessed in the late 90s. Drawing parallels with the sterling's decline, we see that no currency is immune to such a plight. The British pound, too, is experiencing a significant slide, raising concerns about a potential collapse in confidence in British assets and a balance of payments crisis. As we've explored, the Bank of Japan is facing a nightmare scenario. It's caught in a difficult balancing act, trying to save its currency without causing further harm to an already fragile global economy. The decisions made by the Bank of Japan could reverberate around the world, affecting economies on a global scale. In the face of increasing inflation and crashing wage growth, the Bank of Japan is forced to consider drastic measures. If they choose to hike rates in an attempt to save their currency, it could bring the global economy crashing down. As we move towards a potential global inflation crisis, the collapse of the yen serves as a stark warning of the economic challenges that lie ahead. The situation is complex and the path forward is uncertain. But one thing is sure, the world will be watching Japan closely as it navigates this economic storm. The decisions made in the coming weeks and months will not only shape Japan's economic future, but could have far-reaching implications for the global economy.